Good morning, ladies and gentlemen. Well, by my calculations, we're about as neutral on the risk dial as we could be. And I won't even pretend that I have an edge at these levels in these assets because everything is pointing in different directions and everything is halfway between where it could be and where it should be. And therefore, what it's saying is that we are in a period of chop where we're going to go up a little bit, stop everyone out, down a little bit, stop everyone out without getting any clear direction. I have a reason why that is happening. And that's okay. These periods happen and that we have to endure through them. And we just have to trade smaller and wait for even greater extremes before we trade. That is part of trading. It's completely normal and tends to happen before very big moves. I don't know what that is going to be caused by, but I have some ideas and I will discuss with you those ideas now. As always, let's do a brief run through of all the different tenures and maturities in the bonds. This is the 3-month bill. As you can see, not a single day below the center line of the Bollingers. I don't want to, repeat myself. I will include the update on the bonds I did on Friday, so you can go through them through those as well. But basically, nothing's changed. As you go down the maturities, now this is the 1 year, you're beginning to see a little bit of a stabilization and you could get a change. But the further down you go the curve, the more bearish yields, bullish prices it gets. It's basically correcting. This is the 2 year. Now the 2 year is in danger, the least in danger of going down, but in danger that if we start closing here at around the 422, we could easily come down to 401. I was looking for this kind of level on Friday, 442, to get out. Didn't get it. It's what happens in trading. You just mustn't remain stubborn and realize what the danger is. I think on Monday, Tuesday, if he starts trading 420, I'll definitely be out. Threes, the more, the further out you go down the curve, the steeper this line of descent gets. And the less of a correction from the big bar, which was the CPI, you get in terms of correction, and then the steeper the fall. Fives, hardly anything beyond the CPI candle going down. How far can it go? Well, I guess 345 would be a reasonable level to see a bounce from. Tens, again, CPI, hardly anything, continuation. 323, I guess. And finally, 30s, no correction at all from the CPI, and basically we've had since the CPI 50 basis points. So this is what all the spreads are saying. If you look at the really important ones, 3 months to 10 year making new highs. This one's going to be interesting for you on a monthly basis. And then if we have a look, we are now basically at the steepest it has ever been if you sort of take out 79 or 1980, which are completely different. You can do this. You can go for a yearly. Okay, and you can see every time it's been up here, next year what happened. In both cases, it went back down to minus 170, which is just about the midpoint of where you should trade. What is all this telling you? It's more or less telling you that we should get a recession at some stage through, in the middle of next year. Is it going to happen? Who the hell knows? But that is what the spreads are telling you. And if we go back to the 1 month spreads and in all the important ones, now let's go 2s, 10s, making new highs, making new all-time highs if you forget about 79, 1980. Every time this happens, the reversal is brutal. Eventually, 5s, 30s is the one that's stabilizing, the one that doesn't want to go anymore. I'm very much in two minds about 5s, 30s. I'm convinced that at some stage next year you will see it in negative territory here, somewhere around here, minus 57, but I don't think it's worth playing as yet. At some stage, these are pure momentum plays. When this turns and you start getting negative candles, it's going to just keep on going for a long, long way. The timing is not yet. This is what all these charts are saying. Don't get in now because there's no point. The momentum is still to the upside. If you look at the German yield curve, it's much the same picture as in the US. 2s are completely stable. 5s, a little bit of a breakdown. Maybe we will trade between 160 and 2. 10s, bit more impulsion, but very little. I would be surprised if we go past 160. If you look at the clearest one, which is the French, this was my make or break level, where below it we should slowly at least fill this gap, 203, and possibly come to the 50% retracement around 195. Basically indicating much the same as the US. The further down the yield curve you go, the more impulsion there is. At the short end, there is absolutely no impulsion, and basically what the market is doing is validating the Fed's we will hike rates up to the terminal rate and we will hold them there. To me, that is not going to happen. I believe that they'll get the terminal rates up there, but I don't think they're going to be able to hold them much longer than a quarter or something like that, because eventually the yield curve will just want to roll over and go back to its natural shape, because either we get a recession or we don't. And if we don't, they're going to have to hike a lot more, and the long end will respond too. Probably a lot more than the short end at that stage. So in any case, the yield curve in Germany is doing exactly the same thing as the yield curve in the US. 2s, 5s, 2s, 10s, all looking to make new highs. And the one that's even interesting is the 2s, 30s going like the clappers, as it were, up. And if we have a look at a monthly chart of that, you will see that actually we are at the steepest levels we have been since the 90s. All the yield curves are saying the same thing. You don't need to fight them, right? I mean, it's silly to fight them yet. These are pure momentum plays. Once you get a reversal candle, you will know exactly what to do and will be there to do it. If we have a look at the US Germany, and let's go to the dailies, the differential, we are basically coming down. We're doing, a head and shoulders. I would not be surprised to see it around the 2% area and stop there. But the interesting ones are always the 10s, 10s and the 30s, 30s. The 10s, 10s basically are saying every time you get a spike up to 180, between 180 and 190, risk reward says that you'll make 10, 15, 20 basis points by playing on the downside. I don't even need to tell you that. Every time it just works. the big move is not going to come until you start breaking this 152 level and closing below it on a weekly basis. After that, you could get a massacre in this, because this is a long time to trap people up here in a 50-point range. And if you look at the 30s, that also could easily then come back down to around 170 basis points at some stage, which will coincide with the 10s breaking the 250 area. Breaking the 150 area, and coming down to something like 120, 130, something like that, 120 basis points. That, I reckon, is still to come and to be played out. Well, the dollar, 102.82, I think, is going to be key. Now, the real question is, what is the dollar reacting to, and what is it trying to discount? I would have thought that it's trying to discount that at some stage the differential in interest rates between the US and Germany is going to come right in. The only question is, why would it come right in? And to me, that can only be a recession, and the recession that starts in the US at some stage next year, and that basically collapses back the yields down, the yield differentials back down towards zero, especially at the short end, and that the US dollar is trying to discount that possibility, or let's say that probability, for some time in the middle of next year. In any case, even if that is the case, I would have thought that it's not prudent to be short of it below 102.82 or 101.92 on the dailies. It really makes not much of a difference, that, sort of 0.75% difference. I would have thought that the risk reward from those levels is to be very, very flat and wait for some sort of a reaction back up. How high is that reaction going to go? Well, I would have thought 106.25 is about as high a bounce from now on that you are likely to be able to sell with any kind of certainty. Because could it go to 109.29? I think low odds from now on. I think these reaction levels here, 107.30, are going to cap from now on, if I'm correct. So there you have it. There's my view of why the dollar is doing what it's doing. I could be completely wrong. I don't need to be right on the reason. I just need to be right on the direction. And the timing of the direction. And from what I'll show you later on, the timing to me seems to be sometime towards the middle of next year. Well, we know why gold's done better. It's done better because the bonds have done better and because the US dollar's come down. The question is, does one want to fight it much through 1830, which is the proper resistance, and the descending 200-day moving average now? So you will see a lot of things are at the moving average or just that 200-day moving average, stocks, gold, bonds, etc., etc. So I would have thought a period of trading around and below 1830 is probably called for, because I really can't see the bonds doing much better than another 10-15 basis points, as I showed you earlier. And I would have thought that the dollar is more likely to range than to be impulsive for the time being. So gold, it's done exactly what it should have done. And now any kind of move back down to 1764 is likely to be bought, certainly the first time round, and is likely to be decent support. And even if it comes through slightly, it'll come back to 1764. Because the bonds, let's face it, are not in a mood to go higher in yield. And we have no data next week, which should suggest that they will have a big week to the upside in terms of yields. They're much more likely to range around, as is the US dollar. That tells me that any dip down to 1764 in gold, I'll probably should buy. DBC. Hey, to me, it's amazing how the low ticks are exactly where I put the line at 24.39, and you know this has been here for months and months and months. In fact, it's been here since 2015. So, what can I say? I think it's still ranging, but this chart here is telling me, and you know how long this line's been here, this chart is beginning to tell me that the odds are, and it's no more than that, it's no more than the odds are that we are now transitioning to what I've been saying since whatever that is, when we hit this, April, May, that, and when I transitioned most of my long DBC into long gold in my long-term portfolio, this line is now beginning to say, and it's very close to saying, but it's not saying it yet. And it's all there, isn't it? It's beginning to say, but it's not saying it yet. I.e. the yield curve, everything that I'm looking at is saying it's beginning to say it, but it's not saying it yet. The yet being the operative word. Now, if this now turns, okay, these moving averages turn, and we start breaking in price above these levels, and you can see that these are the lows in March and the highs in whenever that is, August, we start breaking above here, we will be taking out this whole range that we've been in since March of this year, and or let's call it April of this year. And we know what happened in April sort of this year, which was basically the low in equities. Okay, so let's put together a macro view. If this were to turn over the course of the next few months, that gold is outpacing DBC, what does that tell us? Well, gold outpacing DBC can only be for one reason, i.e. bonds are doing better, the dollar is weaker, commodities are not keeping up. What is the largest component in DBC? Oil. Why would that not be keeping up? Well, because of demand destruction. What does demand destruction mean? It means recession, right? So that is what these charts are beginning to say, the operative word being not yet. So let's have a look very quickly at a chart of oil. Very, very important level on the monthly, 75.16. Every time it touches it, boom, straight back up. But if you look something at the daily, what is it doing? Okay, it comes down to the level, it comes back up. Where does it come up to? It comes up to a descending 50-day moving average, and now the 200-day moving average is toppling over, which tells me that we are very unlikely to go much higher than the sort of high 80s, very low 90s, and that this is slowly turning over. I know that a lot of people are bullish energy. I can only trade what I see in front of me, and that is a chart which is no longer going up, which is making lower highs and slightly lower lows. At best, this seems to be something which is in equilibrium with these levels rather than something which is impulsive. Where would it start becoming impulsive? I think it will start becoming impulsive if for whatever reason we start breaking the 75 level, because then we could easily trade all the way down to the 50s, or sort of this kind of level, or even this kind of level. So whether it's 61 or 50, it really makes not that much difference, because what it's saying is the same thing. There is an awful lot of demand destruction. We all know about the supply side of things and how tight it is. Well, if the supply is tight but the price is going down, that can only mean that the demand is even weaker. So it's all beginning to paint a picture, but a picture of not yet, right? Is this likely to break down this month? I very much doubt it. It's more likely to come and, test these 90 levels than it is to break down the through 75 and stay there. That's what it's telling me. If you look at the 60-minute, it's more likely again to do some kind of an ABC and test these levels and then finally come back down again. So everything I'm looking at here is telling me there's a picture being painted, but not yet is the operative word. As I've been saying for quite a while, I just can't get bearish the S&Ps. Not yet. Now, I don't know who this chart, this is the 195 minute. I don't know who thinks that this looks bearish, but, sort of higher highs does not look bearish to me. So if we get rid of that one and we have a look at the daily chart, still doesn't look bearish to me. I think it's far more likely to, test, get everyone bearish on a test of 39.83, and then spike up and trade, around the 41.80, 4200 area, and get everyone bullish and then collapse. It just is not a bearish chart. I just can't get, short of it, because I don't see any point in getting short of it until it gets to some extreme. Maybe you can see it better in this chart, which is my clean chart. Really until it gets to at least this level, 42.55, anywhere between 41.26 and 42.55. That is the area that is much more likely to be the top rather than any other. I just can't get short of it here. I just don't see any point. I think if it trades down to 39.83 at some stage, between 39.83 and 39.34, it's a much better long than it is a short. As simple as that. Why can't I get short S&Ps? Well, because there are sectors which are doing fantastically well. This is, my favorite that I'm long of, ITA, which is basically defense contractors. This has made a new high for the year. Okay, so this is 2021, this is the beginning of 2022, and we are now making new highs on this whole period between mid-21 and the end of 22. So, even if it comes back slightly, it's still not bearish, it's bullish. There are certain sectors which are doing extremely well. Just because some are not doing fantastically well does not mean that others are not doing extremely well, and they will hold up the S&Ps for the time being for sure. And now a chart which, instead of telling you to be bullish, tells you to be extremely cautious at some stage, and that stage is not yet. So if you've been with me for a long time, you will know this chart. This is XLF, is the normal price chart, and the blue lines are the differentials. Basically, it's the yield curve. I don't need to go into long explanations. Those who have been with me for a long time would get very bored by it. The only thing that it matters is that when it diverges hugely, you know that the crocodile jaws are going to close at some time. So let's have a look at what happened the last time we were at these kind of extremes, and you can see we are at complete extremes. And let's go back to the year 2000, and here we are. We had a complete move from 2001, when the Fed basically stopped tightening and we went and started easing, and we went into a huge run up in the yield curve, i.e. it went positive. And what happened to XLF? It went boom because of the recession. So these jaws closed the other way around, mainly by, sort of one going up and the other one going down. What is more likely than not, and we can actually have a look at what happened. We can't go back here, sorry. If we go now to 2007, and here we are, you can see how the jaws again closed because of recession. XLF took a complete bath and the yield curve went back up. So what is this saying? This is saying to me that at some stage this is going to happen again. XLF is going to get murdered because of the recession, and the yield curve is going to go straight back up. Why does XLF get murdered in a recession? Well, it's the balance sheet, isn't it? It's the quality of the balance sheet. Are the banks going to get repaid? So it will happen again. This is something that for very, very long-term accounts, you just at some stage, sort of take to the bank. You do the reverse yield curve and you short XLF, knowing that at some stage, it'll meet back in the middle and you'll make a lot of money. But again, this is another chart which is saying, guess what? Not yet. In fact, there isn't a single risk spread that is telling me that we are in immediate danger of equities, even on a relative basis, giving up ground against bonds or any other asset. The totality of the equity market against the totality of the bond market is trading in a very stable pattern. Whichever one of these risk indicators you look at, if you look at SPY IEF, it's very stable. SPY TLT, it's the one that it's most extreme, but that's because the 30s are coming off most. But that is still not a bearish pattern, okay? You're not getting lower highs, you're getting higher highs. It's in a bit of a retracement, but that's not, the end of the world. Even if you look at QQQ against TLT, and you would have thought that QQQ would be the sector most in trouble, it's basically trading in a stable pattern where it's been trading since August of this year. It's sort of like going up and down, and you're not getting that pattern which indicates that you're about to collapse. You're just not. If you look at the equal weight between discretionary and staples, it's very, very stable. It's not doing anything. It led beautifully all the way down, and it's basically been stable since what? April, May? Indicating that we are not getting any pressure at the moment for lower equities. Whichever one of these spreads you do, and you're welcome to set them up yourself, and this is the one that I would have thought would become a leader, i.e. SPY over the the Russell retailers, because if there's going to be a recession, these guys should get absolutely killed, while SPY, holds on. Well, we've been basically stable since Well, April of this year, and it all goes back to April, May, doesn't it? When the markets basically stopped being in trend and doing anything. I'm not going to get bearish until we start breaking this level here. I'll put a line in it, and I really can't start getting bearish of equities until I get, a reason from these charts to start getting bearish. And they're just saying not yet. If you want a fundamental reason level to start getting bearish at, or certainly lightening up significantly on your equity holdings long term, well, I would have thought a good indicator, as good as any, is going to be when you touch the times 18 line. You saw last week that a lot of houses brought down their E expectations for next year. You know, the timing is going to be important for when we, sort of start discounting that. And I would have thought that when we get to times 18, unless the bonds are rallying like crazy, and I can't see that as I showed you before, you're talking about this kind of level, which is just around the 4200 level or just below 4200, which basically ties in with what I showed you just earlier on my clean chart, that those levels, around the 4140 all the way up to 4225 are basically the kind of levels that you are supposed to short. 4125 to 4255. Let me put it this way. I don't know if you're supposed to short them. You're certainly supposed to lighten up on your equity holdings longer term, and maybe look for a dip to rebuy it if you want to trade it, or just be well out of it until the picture, the macro picture changes, and the expectations start going for lower earnings next year start disappearing. You might have to pay more than where you sold it, but I doubt it's going to be very much more. Volatility is basically confirming that the market is not looking for any kind of imminent move to the downside. I mean, would we be trading 19% VIX? This is the lowest basically we have been all year. We started the year at, well, let's call this, what is it, 1730. So we are within 2% of where we started the year. It just wouldn't be happening like this. I think it's far more likely that we break this 1850 level and get everybody bullsed up right at the worst possible levels in S&P, i.e. above that 18 or touching that 18 times line, and that we are ready then for a very nice retracement. I think that is far more likely than we go down immediately. So if I can't see any reason to be short of S&Ps, I will definitely wait for either fundamental levels like the Blue Angels times 18, or those, and again I can show you these levels, certainly somewhere around in this area between 4125 and 4255. And probably the ideal is to fill this gap, isn't it? For just above 4200. It's December. It's going to be thin. The Fed is going to do exactly what the market expects, i.e. 50 basis points. And the market could easily rally into a 50 basis points. So what I'm saying is, it's not yet. If you are bearish equities and you're looking for a recession and all that, there isn't a single chart that says it's starting now. The yield curve is not saying it, volatility is not saying it, the risk spreads are not saying it. I can't see a single reason you want to be short here and today. With that, here are all the levels. I've marked them. still think that if we see anywhere near 39.83 to 39.43, it's very well worth the long. The shorts really are not worth even thinking about until this kind of level on the dailies and weeklies. Really not worth thinking about. I think the NDX is far more likely to trade 12,429, and if these match, then it's probably time to give it a go on the short side, but not until then. In any case, I'll put down here the link to the bonds that I did early on Friday morning, which describe the yield curve and each individual tenure in far more detail than I've covered today. So basically, you can just click it and download it. Thank you very much indeed. Have a wonderful Sunday, and basically we have to learn patience. That is what the charts are saying. Learn patience and stay patient.